In this video talk, we want to step you through a hypothetical equity splits portfolio so you can see how these portfolios can be designed to sustain both your entrusted corpus and your ability to continue paying benefits on those entrusted funds over time. We start by pointing out that all of these numbers are in millions of dollars, and so this portfolio includes one transaction in the millions of dollars and three transactions in the billions of dollars. It's actually a very large portfolio, 222 billion plus. Obviously, this would be some kind of a club portfolio that would be shared out among multiple stewardship investors. But we wanted to build it this way so that we could give you a sense of how this works across a range of investment opportunities, including a renewable deal, renewable energy deal, a green deal, biofuels, which is a fairly small amount of money, 72 million, and then some more high-profile public companies that we would be taking private in a transaction like this. Procter & Gamble, which is the large branded products company. Schlumberger is a very large international oilfield services pipeline type company. And Microsoft, of course, is the technology giant in the computer space. And so we start with fiduciary funds being prudently invested at 222 billion. You'll see we keep these funds flat across the life of this iteration. We want to just extract out how this thing would grow over time, inflation and reinvestment, because of the complexities that comes with that, and really focus on just the top-down deconstruction of what these portfolios are built to do. And then we want to point out that this model runs out for 20 years. That's the length of the base case that we used in constructing it. That base case is really designed for scheduling your principal recovery, which we'll look into more detail in a few minutes. The companies will continue to operate in almost all scenarios beyond this 20-year period. The portfolio will continue to generate cash flows back to you on your entrusted funds beyond 20 years. But we had to stop it somewhere so that we could fit it in the page, and 20 years is the period we stopped it at. So looking at the earnings that are required for you to meet your fiduciary obligations, we have these three line items that we've built in. One is a makeup for inflation at 2% of funds being prudently invested. The other is 5% for paying out benefits. Again, these percentages are based on what you're prudently investing. And then 1% for your cost of administration. And so your total fiduciary cash needs are budgeted at 8% of the funds that are in this portfolio, and that's a $17.8 billion annual need. We don't escalate that because we're not escalating the size of the portfolio for simplicity, as we've said. The first thing now, so we get total earnings here, which grow over time as these companies grow. That's just taking it down as a total from the individual base case results that have been built into the structure. That comes back down here. And the first thing we do is we apply these monies against capital recovery on a scheduled basis. You can see here at the end of 20 years in this model, there is no scheduled capital recovery. That's because we've already recovered out of this portfolio everything we put into it. The entire 222 plus billion dollars has been pulled out along with the funds that have been required to meet your fiduciary obligations, and some surpluses are growing here. And again, because the 20-year stop date is artificial, these surpluses are going to continue coming into your fund over time. And so what we've got here as available to meet fiduciary obligations is the difference between the total money coming in and what we're reserving for capital recovery. And when you subtract that out of what is actually needed based on the budgetary requirements here, you get this line where there are some shortfalls in the early years growing to substantial surpluses. There would be some really interesting conversations we could have about designing a portfolio where we would be able to minimize and maybe eliminate these early term shortfalls and accelerate some of these later term surpluses. But this is just how this particular portfolio did manage to land out. The last thing here that we want to emphasize is we are collecting capital recovery. We're recovering corpus in increments over time throughout the life of this portfolio. And we've done nothing in this particular iteration to show you the impact of reinvesting these funds. And you can see, even if you don't reinvest these funds over time, you're building substantial cash flow surpluses over what you would need to support your benefits program. And so this gives you an opportunity to really build a portfolio of blended values, where if you want to, you can look at participating going forward with maybe some lower financial return investments because they have such high societal impacts, while you continue to also look for high financial returns where the societal impacts are maybe more benign. And so that's the way in which a hypothetical equity splits portfolio is going to be designed to sustain both corpus and your benefits on your entrusted funds.